The Combs.
Market suffering through a brutal week. The market in a search of hope, silver linings. Whatever they can find here is the questions. You know them as well as I do. The market at this moment down 100, trades 64.88. Welcome everybody to the closing bell. I am Dylan Radigan here on the floor of the exchange. Hi, Melissa.
Hi there, Dylan. I am Melissa Lee here at CNBC Global Headquarters in today for Maria Bartiromo. And as expected, the suspects in today's market as far as the downward pressure, financials down for the sixth straight day. REITs also adding to the pressures. S&P threatens to downgrade a number of them. Dow Jones Industrial Average down 1.6%. 104 points is the loss right now. 64.89 is the level. Over on the NASDAQ, Apple certainly a pressure there as JP Morgan cuts the sales estimates on that name. 1271 is your level there, down by 2 full percentage points. And on the S&P 500, we are seeing losses there as well. Of course, financials, we should note the XBD, Amex Broker Dealer Index down by more than 4%. The S&P 500 is down by 2%. Dylan.
The good news, bad news story of the day has to be the jobs report, which again was a meaningful contraction as expected. The bad news, the good news, the market again appears, at least as it pertains to weakness in the labor market right now, to very much have that particular aspect priced in. The banks obviously can't get much going, and the market waiting for some version of a direction for this economy. In other words, are we seeing a meaningful deceleration yet in the rate of decline? Not quite sure, and as a result, the market continues its churn. Apple, one of the names taking it on the chin today as a result of concern about their sales going into the balance of this year. But we'll begin things here on the floor with our friend and neighbor, good friend and neighbor, in fact, Mr. Bob Pisani. Hi, Bob.
Yeah, in fact, we're only 50 feet away from each other. Hey, where's our rally? All right, we've been waiting for 2 weeks for this thing, and it's still not materializing. Let me go through the machinations as traders as they weep and wail and give me a hard time about what's happening. First off, everybody believes there's a rally that's coming simply because we're so dramatically oversold. So here's the problem here. While everybody believes that there's a rally coming, very few people are actually positioned to take advantage of it. When I ask them, oh, so you think a rally's coming, how are you positioned? Well, I'm mostly in cash. Well, why are you mostly in cash? And the reason is nobody can afford to have another 10% down one. And by the way, we're down 7% on the week. So if you keep doing this and you keep moving down, eventually you're out of business. So they're all on the sidelines and afraid. So who's still selling that's out there? The biggest thing that I can see is that the retail people are continuing to sell. That's your average investor, okay? We had $30 billion in redemptions in mutual funds in 5 days ending on Wednesday. That's according to Trim Tabs. $30 billion, and this has been going on weekly for several months now. The institutions appear to be still holding. Those are the pension funds, by the way. Hedge funds, it depends on who you call. A lot of people are nervous, but by and large, I don't hear of massive redemptions in the last couple of weeks, although there was some in the end, towards the end of February. So there's what we got. So what does a rally look like in a bear market? It looks exactly like this, folks. This is the November 20th bottom. This is a 2-month chart. There's the bottom, November 20th, and there is the December 31st. This stretches for a month and a half. We had a rally from 750 on the S&P to about 900 at the end of December. There is a bear market rally. That's 20%. So you could get this very quickly in the next several weeks. What happens? You're at 670. You go from 670 to 800. There's a 20% rally, and that's what the chart looks like for the last 3 months. The problem is a lot of people don't believe that that rally is going to be sustainable, and they think it'll be the same situation as what happened at the end of December. That is, we move back down again. Just let me know, Wells Fargo here, and you'll see what happened. They sold financials off right after 10 o'clock Eastern time, as they do every single day. Wells Fargo cut the dividend, but had some positive comments about the first 2 months of the year. That stock is in positive territory right now. TraderTalk.cnbc.com for more. And Scott, still on the downside on the NASDAQ.
Absolutely, Bob. Thanks so much. And come to the wall with me because we haven't seen these levels in some 6 years. March 2003, the last time the NASDAQ dipped to intraday levels like the ones we saw today. Right now, we're down by better than 2%, 1272.31. That's a loss of 27 points. Most large-cap technology stocks, as you take a look at that chart that I was just mentioning, again, going all the way back 6 years to find those levels. But Apple's certainly one of the culprits today, down 6%. But Google's weak. You heard at the headline at the top of the show here, JP Morgan taking down the sales estimates over at Apple. Macro pressures they cite, overly optimistic. Matt and iPhone estimates there. So that's dragging that stock down. But really, it's across the board selling in technology today. Research in Motion's getting pounded 6%. Cisco down 3.5%. Google's off 0.5% today. Intel's weak. Obviously, the chips are weak today. Microsoft is off another 2%. Amgen's down 3%, so even that's not helping from the biotechnology space today. It was removed from Goldman Sachs' conviction buy list, and the stock's been under pressure really all day long ever since that news broke there. Take a look at Whole Foods, which is also now gone negative. It did settle with the FTC over that acquisition of Wild Oats Market. It's going to give up intellectual property and also the rights to the brand there. Whole Foods in positive territory throughout much of this trading day has since gone negative. Oracle also negative. Let's go to Sharon at the NYMEX.
When you consider all of the negative economic news that we've had this week, you look at how stocks have fallen so sharply, it's pretty amazing that oil prices here are above $45 a barrel and that they've actually gained on the week here. Technically, a lot of the analysts say this market actually looks quite strong in light of all of this. We are looking at prices, though, that may go back up to the upper end of the range they've been in since mid-December, between $32 and $50 a barrel. Keep in mind, gasoline also quite strong this week, even though it looks like that jobless data would have a severe impact on energy demand, specifically gasoline demand. We have gasoline up today, heating oil up today, but natural gas at a 6-year low. Industrial demand definitely hurting natural gas prices, and they're below $4 right now. Looking across the board in commodities, the real strength there is in copper at a 3-month high, and the correlation between crude and copper, Tradition Energy's Addison Armstrong points out, is about 99% since the beginning of the year. A lot of folks looking at the optimism on China and playing copper as a result. Gold, on the other hand, gold also up. Flight to quality there today. We're looking at gold up about $11 on the session, but still basically flat on the week. Rick Santelli, over to you. Have a good week.
Thank you very much, Sharon. You know, Bob Pisani said, we've been waiting for a rally 2 weeks. 1 month ago, we had a labor report that wasn't all that much uglier, actually a little less ugly than this one, but the stocks closed higher because they were looking forward to the stimulus package. That's passed, come and gone. Look at what's going on in equities. Now let's look at the week in some other areas. The pound. The Bank of England lowered rates. They said they're going to be buying debt in a quantitative easing mode. It didn't help their currency much, as you can see on this chart, and the yield on their 10-year maturity dropped by over 50 basis points. Let's look at our yield curve. Let's look at 2s on the week. They're down 5-6 basis points, but look at 10s. They're down about 20 basis points. So we continue to see that curve dynamic, even in the face of supply. The thought of governments buying the long end is having an effect on traders. Now let's look at what I think is a metric for the credit anxieties, and there's certain ones that have been well behaved. This one's starting to act up a bit. It's a 2-year swap. It's gone from below 70 to almost 80, the highest levels of 09 plus. Well, Melissa Lee, back to you, and have a good weekend.
You too, Rick Santelli. Thanks so much. Shares biotech giant Genentech popping after Swiss drug maker Roche announced in the middle of the trading day that it is raising its bid for DNA. Take a look at the stocks right now. You see DNA shares popping 10% on the session. CNBC's pharmaceuticals reporter Mike Huckman's been following this takeover battle from the start. Joins us now with the latest. Mike.
Melissa, just 4 days after Genentech made its case for more money at an investor analyst meeting in New York, Roche has come through. The question is whether this new offer is one that Genentech shareholders can't refuse. Roche has a majority stake in Genentech, but it wants to buy the whole thing so it can grab all the revenue and profits from the California biotech's lucrative cancer drugs and fully capitalize on the company's drug development pipeline. Now, many analysts and investors believe Roche is trying to get this deal done before test results come out next month on whether Genentech's Avastin works on earlier stage colon cancer. If it does, estimates are it could add several $1 billion a year to this drug's revenue. Roche says this new offer will now expire at midnight on March 20th. That's a week later than its previous hostile offer of $86.50 a share, at which price only 500,000 shares had been tendered. No big surprise there. That was down from Roche's original bid of $89 a share, which was made where you see that big spike mid-year last year. A key statement in the Roche press release comes from Chairman Franz Humer, who says the new price is based on conversations with Genentech shareholders. Meantime, Genentech is urging its shareholders not to do anything. The company says its special board committee will take a look at this new offer promptly and give a detailed explanation of its position on it in an SEC filing. For more, check out the blog, farmersmarket.cnbc.com. Dylan, the saga continues.
Indeed it does. Thank you, Mr. Huckman. The markets, as we know, on new lows, surviving this process. The single most important variable. David Darst, Chief Investment Strategist over at Morgan Stanley Global Wealth. Jordan Kimmel, Managing Member, Portfolio Manager at Magnet Investment Group. Welcome you both to the conversation. Survival. Where do you begin and what are you doing?
You want to survive by being in tips. They're down only 1% for the year, with the market down 25%. You want to basically husband your capital. Another one is master limited partnerships, which is an income-oriented play on energy throughput and energy infrastructure. They're down only about 3%. A third area would be biotech. You're talking Amgen, you're talking Celgene, you're talking Genentech. These are ways to survive. Obviously, higher than normal cash. But be prepared. We will live to fight another day, Dylan.
Yeah, Jordan, for the buy and hold crowd that has ridden this and may well be still continuing to ride it, 401ks, retirement accounts, that entire community, which is a huge percentage of the investor base in this building and across this country. Right. What is your counsel to those who have watched, again, the rise and fall of those accounts at this point?
Well, the thing is, obviously it's too late to sell, but I think that more importantly, you have to know that each market's led by new names, and a lot of names that people are clinging on to may not be there. So I think it's a matter of keeping the list fresh. The biotech, David said, was dead on. A couple of our holdings in biotech doing very well. The key is here, this is a liquidity-driven crunch, not valuation.
What does that mean? So
what it means, people are over-margined. The bull market creates excess. This is all about excess, and now the deleveraging, the unwinding. Having cash around is great, but if you think the market looks terrible, you have to ask, are you a buyer or a seller? If you're a seller, it's terrible. If you're a buyer, I'm willing to look a little further out. And I think you have to be putting money to work slowly here.
If you look at some of the policy variables that are clearly where they're headed, how they get there we may not know, but they're going toward some version of generic drugs getting more support, more structural, systemic, direct, indirect support for that business. Alternative energy, I could say the same thing about. There's a couple of other things on the list. Is there a rational way to invest in the private markets knowing that the government has got a couple of big targets?
You want to work on, you want to have the government behind you. I support Bill Gross saying buy what the government is buying, and I think infrastructure is another one. Look, I hate to bring it up, but General Electric is a major infrastructure play. Asian air travel, turbines, locomotives, that's a tremendous play on infrastructure, along with the generics. Also, pharmacy benefit managers. These help companies keep their costs under control. Retail drugstores, Dylan, that's another area. Basically, the people who have lost confidence haven't finished selling. That's what's hurting right now. Number two, you had a major technical breakdown when it broke through the November 20th low of 752, 740 intraday. So we've penetrated that decisively. And number three, by the price earnings and price book metrics, they would bottom out. A classic bottom screaming buy is about 20 to 25% below here. So those are the things that are, I think, driving people right now.
Do you have enough, particularly in your last comment, which is that to suggest that another 20 to 25% lower in equity prices certainly should be entertained as a possibility, whether you want to hear it or not, that you ought be have a short position?
Buffett's letter that he sent out October 16th basically told people to buy the S&P was 950. It's now 668. Not to criticize him, he's the master, but it was very much unlike his letter of September 74. Nixon resigned August the 8th, 74, in which the dividend yields were 10% and the PE was 7. We're still way below that on the yield and way above that on the PE.
Jordan?
Right, well, I agree with a lot of what David's saying. The only difference I make is that I don't buy the whole market, and a lot of the big caps look the worst. I think that the small amount of stocks that actually have revenue growth, have margin acceleration, have good valuation, I find them mostly small and mid caps. They usually lead the market out anyway. So a lot of what David is saying is dead on in terms of the sectors. I drill down even further using a magnet process to find companies, but a lot of the big guys, I actually do short. And there's plenty of shorts out there. So although I'm more bullish than most, it's stock selection more than anything else.
The nice thing is we're going to bring you guys back. We'll talk some more about all this, David and Jordan. Melissa, what's going on with you?
Hey there, Dylan. 46 minutes till the final bell rings for the week on Wall Street. Right now, we've got the Dow down by just about 1.5%. The Nasdaq, though, trading at levels we have not seen since 2003, Dylan.
Well, with the declines in General Motors, Citigroup, you know the names. They, my friends, are Dow components. The big Dow shakeup coming down the line. Up next, a debate on which names should come in as Citi and GM clearly are headed out.
And after the bell, we will debate whether foreclosure should be forgiven on credit reports in order to encourage foreclosed homeowners to get back into the housing market.
But first, most active names right here at the New York Stock Exchange. There's your GE trading 689, Bank of America, JP Morgan, Wells Fargo, and just to break up the monotony of the banks,